It's a global warning. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, this major country's economy is about to implode, and this is something we've been warning about. And as you're about to see for this country, they're past the point of no return. And as you're about to see, there's another casualty, the post-pandemic economy. We'll show you why more companies in this sector are soon to follow. And will the political elites run to the rescue, or is it far too late? We'll show you what their next move will be next week and why it won't make a difference. Now, let's head over to Bloomberg, where we picked today's story up with a headline, as U.S. manufacturing activity contracts for a 7th straight month. And this is dangerous news for the U.S. economy at a time when investors are exceptionally bullish. They believe we're going to achieve a soft landing and stocks are going to roar. But yet, what we're seeing underneath in the U.S. economy is that we're about to implode, because when you lose your manufacturing sector, as we're seeing what's happening in China and in Germany, once that's gone, well, the rest of your economy is soon to follow. The Institute for Supply Management's factory gauge fell to 46.5 and has now been contracting, meaning a reading below 50 for every month except one in the past 2 years. And yet again, despite that, the bullish fever from Wall Street, from consumers and investors, is that everything's going to turn around as soon as the election's over. But when we look at the manufacturing sector, things continue to get worse, and that's a dangerous sign, because at some point, if we don't see a turnaround, well, that means we're going to see mass layoffs in the manufacturing sector, and that will soon flow to the rest of the economy. Production activity has also dropped sharply in October to 46.2, making it the biggest monthly decline since April 2021. So any notion that we would see some sort of soft landing narrative in the economy, or from the manufacturing sector, or from the fact that perhaps that Wall Street's already priced in a complete Republican sweep, we're not seeing companies respond with orders here. And what that means is layoffs are coming, and in a big way, because when we look at capacity utilization, this is shown in blue. This is the percentage of a factory that's being utilized for production. So when you see a sharp drop in production, well, that means capacity utilization is going down. And when that happens, well, you start cutting hours, and next thing you know, you start cutting heads, because you don't need that many workers if you don't have that many orders. And here you can see against the unemployment rate in red, as capacity utilization falls, the unemployment rate rises. And you'll notice this relationship. It's a near mirror relationship, and it happens every time we head into a recession. You see a drop in capacity utilization and equivalent rise in the unemployment rate. And here we're seeing it now, not in the official data. Of course, the ISM is survey data, but showing a big plunge in production. That means capacity utilization is heading down. And any notion that we just saw the peak in the unemployment rate, well, what it means is, from, of course, the labor market's perspective, things are about to get much worse. And here we can see from the chair of the ISM Manufacturing Business Survey Committee, he said he didn't think the disruptions from the two major hurricanes, Helene and Milton, had a significant impact on demand. Now, that's very interesting, because we've heard from other sources that the hurricanes were. But now what we're hearing from inside the manufacturing sector, it's not due to weather, it's due to demand, and that is a big problem. However, the uncertainty about the outcome of the U.S. presidential election is hindering investments in inventory and capital expenditures as companies wait to see what economic policies will be enacted. Now, granted that some of that is true, but broadly speaking, has nothing to do with the election in terms of inventories, because when you think about inventories, why do companies build up inventories? Because they think they're going to sell it. And if they're not moving product, well, what do you not need? Well, you don't need inventories, as this next chart proves. When we see advanced retail sales less the consumer price index, or what's called real retail sales, that's in blue on a year-over-year rate of change, and we have that against retailers' inventories. And I want you to see what's really gone on here, because over the last 2 years, we already know that real retail sales have been largely negative, and that, of course, has an impact on the manufacturing sector. But look at what happened with inventories. Despite the fact that real retail sales went negative, we saw inventories come down, and now all of a sudden they're heading back up. And what that means is there's a lack of demand in the economy. So when we think about this from the consumer perspective, you see a lot of these articles, they look at it from the manufacturer side and start questioning, well, why aren't they building more products and more inventory? Well, it's because of the election, or it's because of uncertainty. Well, it has everything to do with the consumer and their spending, because if consumers don't spend, the next thing you know, there's no need for more inventory because you see it rising. And if that's rising, well, then the orders at the manufacturing level go down. And that's the challenge here, is because the question we should be asking isn't what happens after the presidential election. The question is, will consumers come back and spend? And right now, the indicators say not a chance. And we're probably going to stay in this slowdown period all the way through the end of the year. And we probably won't start to grow until January or February. Now, the question then is, what's changing in January or February? And based on the data, based on what we're seeing, I don't see anything that's changing. And that's the problem, because if you want consumers to spend, what they need is more income, or they need to see their debt service costs and other expenses significantly drop. But if they're worried about losing their job and their income's falling, you can bet or believe they're not going to spend. And here when we look at real retail sales, again shown in blue, against average hourly earnings multiplied by average weekly hours of production and non-supervisory employees, or what we call total income from production and non-supervisory employees, we can go back heading into the dot-com bubble, and what do you see? A slowdown in real retail sales, despite the fact that incomes were rising. And then as income started to slow down, well, then that was a foregone conclusion, because that sends us right into recession. Now you fast forward to the global financial crisis, you see something similar now, where real retail sales were just slightly positive. Right now they're negative, and look what happened. You saw incomes rising, they peaked, and then they started to decelerate. The problem was inflation was too high, and that meant consumers could not spend as much, and we headed right into a recession. Now let's see where we're at. Looking over the past 2 years, and again, we talk about the factory sector saying it's been in kind of this downward trend for 2 years. There's a good reason. Consumers aren't spending. And the idea here that, well, maybe something will change in January or February. Well, the change would have to be is this decelerations in total income would need to turn around. And right now, there's no indication, because if you continue to see capacity utilization at the factory level decline, well, that means there's going to be no demand for more workers, and those that are employed, well, they're not going to get more hours. Those are the two things you really need to see, because we come back to real retail sales, and now we're going to look at it against the unemployment rate that's shown in red, and it starts to become very clear that as retail sales decline and slow down, as you see here going into the dot-com bubble, what happens is the unemployment rate rises. So this is a function of not just the fact that retailers need fewer employees and wholesalers need fewer employees, it's all across the supply chain, all the way up to manufacturers. Less demand means less workers, and we see that happen again going into the global financial crisis. You see that long deceleration in real retail sales. Eventually, it impacts the labor market, and then next thing you know, it spirals out of control. Today, we hear from the Fed that says the unemployment rate's peaked. We said that's not likely at all, against the fact that real retail sales have been negative for the last 2 years, and it starts to make sense of what we're seeing in the factory sector. So unless this turns higher in a big way, what it means is the unemployment rate is about to make a big move to the upside. And factory price pressures on materials and inputs returned last month, even after dipping in September. So this is a big problem for consumers. We already know they can't afford higher prices, and now what are we seeing at the factory level? Prices are going up. You want to know why they're really not building inventory? Aside from the fact that they can't actually move the inventory they have at higher prices, they know there's even fewer buyers. So if you're going to build it, you better make sure someone's going to buy it. In this case, they already know demand isn't there at higher prices. And the prices paid index rose 6.5 points, the most since January, to 54.8. A Boeing strike, along with the two hurricanes, may have limited supply and driven up prices, and that doesn't matter why they've gone up. What matters is the fact that consumers can't afford higher prices. But something that we think is going to head higher, that should be your trading account. Let's look at this recent trade that we took on kind of around the middle of October on GDXJ. We give you all the data. When our reports come out and give us a recommendation, I review each and every one of them. This from our Momentum Timer Pro report. If you're trading momentum like the RSI, the MACD, and those other technical signals, and you're struggling with it, we aggregate them together and we run a proprietary overlay to smooth the signals out to put the odds in your favor. And then we do something really special. We ran a back test on it so we know which signals have a 50% or greater chance of generating a positive return for you. We're giving you all that data, and soon it's going to be fully integrated into the report. You get the daily report, the tradable signals. I give you my opinions on all the best trades, full back test data on all our reports, stop loss levels, tracking of every trade on the books and return, complete update every weekend with stop loss levels, fully duplicatable, and a 30-day free trial. Links in the description below. Because two measures of orders and employment remain in contraction territory last month, again, if you were trading GDXJ, your brokerage account would be moving higher. But while both improved somewhat, the ISM Manufacturing Employment Index rose to 44.4, the fifth month under 50, meaning manufacturers are laying off. And this is exactly what we said would happen. And that's a problem for the U.S. economy, because if we go, the rest of the world stands absolutely no chance. You think China can turn around if we go into recession? How about Germany? They need people to buy their cars. Well, we're already seeing the fact that American consumers aren't buying as many cars, mainly because they're not commuting every day, and boomers are retiring and find out they don't need as many vehicles. New orders remained in contraction, increasing to 1 point to 47.1. Of the six biggest manufacturing industries, only two saw growth. That is food and beverage and the computer and electronics sector. The ISM report also showed inventory shrink to the lowest level since June of 2012, suggesting producers are keeping stockpiles lean. Again, why would they do that? One, there's no demand, so there's no need to build up inventory. Number two, they're hoping prices come down because they desperately need it. They know if they build high-cost inventory, they're going to lose money on the margin. They don't want to do that. But when we look at the manufacturing sector in detail, we see the perfect recipe for the U.S. economy heading into recession, for millions of Americans being out of work, and we see it right here in the ISM report. And what do we look at? First of all, it's new orders. They've been in contraction now for 7 straight months. So that means demand from retailers and wholesalers is dropping. When the fax machine doesn't run, well, you don't need as many workers. But look at the backlog. So one thing you can do, if you don't have a lot of new orders, again, that fax machine not running, you go back and see where you've got some existing backlogs. Now, 25 straight months and the biggest drop in backlogs that we've seen in a very long time. What that means, at some point, you've done cutting hours, and next thing you know, you've got to cut workers, because if you don't have work for them, well, there's no point in paying them to stand around. But let's take a look at what some of the respondents were saying, as there appears to be a general pessimism in the economy that's driving customers to be more restrictive in their capital expenditures, including investment in commercial vehicles. Or we could just say it's not pessimism, it's the fact that the economy here in the U.S. is headed into recession. Arguably, we're in the early stages of one. And so that's not pessimism, it's just reality. And uncertainty in the outcome of the upcoming election has resulted in several risk analysis studies to be prepared, particularly focused on the future of electric vehicle migration and trade restriction penalties. So yes, there are factors there that we could see changes in laws and policies, but look at this. Sales have been very slow the past 6 months. Interestingly, though, inquiries are up more than 30% a year ago. This indicates there's pent-up demand, but customers are skittish about national and global economic conditions, or it means people are window shopping because they just realize they can't buy. You know, there are people that go to car dealerships just to look at cars. They know they can't afford them, but they want to see the new models. And that's not unusual. People go to malls and stores all the time. They look, but realize they can't afford it. It's not about pent-up demand. If they had the money, they'd buy it. The reality is, as we've talked about, there's nothing that's changing over the next few months or into early next year that indicates consumers are going to have any more money. In fact, they're likely to have even less. Business levels remain depressed. It feels like a wait-and-see environment regarding where the economy is headed. Well, we know where it's headed. Customers don't want to commit to inventory, which is resulting in lower order levels. That's because customers have too much inventory. That is the problem. That's been one of the problems, is that inventory levels are too high. They need to come way down. And of course, we know that if they don't happen, if we don't see inventory levels drop, that means retailers are going to have to slash prices anymore. They're going to take, of course, a hit on the margin. That means Bad news for future earnings. Companies don't want to do that, so that means no more new orders. The survey does, as we look at S&P Global's data, however, provides some encouragement that the current soft patch could prove short-lived. Again, there's no evidence to support that, as they're hoping, again, keyword hoping, that demand will pick up once the uncertainty generated by the presidential election clears. The question is, I don't know anybody who's uncertain about their spending because of the election. I've talked to nobody that says, hey, you know what, I was going to buy a car, but because of the election, I'm going to wait till it's over. Or I needed to go spend some money on something, but I thought I'd wait till the election is over. What they're really looking at is they're going to work and they're asking the boss, do we have any new orders? And the boss is saying, not really. Do you see the fax machine running? And then they're saying, well, why don't you work on the backlogs? And the employee says, wow, there's not that many left. And that's the dangerous sign. It's not about the election. It's about the reality that demand is plummeting. And further evidence of that now is TGI Fridays is the latest casual dining chain to go bankrupt. And mind you, there's going to be more companies in the restaurant space that go under, and for lots of reasons. Let's take a look here, because the primary driver of our financial challenges resulted from COVID-19 in our capital structure. Now, why would they say COVID-19? Because TGI Fridays is a restaurant you don't see out in suburban America. You see it in downtowns and business centers. That's their market. That's who they cater to business travelers, to people getting off work, going and having a drink, the lunch crowd. The issue here is when you have people working from home or on a hybrid schedule, they're not going to the office or not eating out. You want to see why there's going to be a push to go back to work? It's because more companies are going to fail. We're going to see more restaurants in particular that had a business model like TGI Fridays that are going to go under. And this is, again, only the beginning of it. We're finally starting to see the economy running out of money, consumers stopping spending. We're seeing, of course, this migration to the work from home starting to really make an impact on businesses. And right now, there's not much that's going to change it. But will the Fed save the day? Well, many people say another rate cut is in the cards. We agree, as the Fed is on track for a rate cut after weak jobs data and hiring markdowns, but that's not the reason why. That's what the Fed's going to tell us. It removes all doubt that you're going to get a 25 basis point cut in November and another one in December. This from the chief U.S. economist at T.S. Lombard. Well, that would be a match of the 2000 playbook. The reality is we're going to hear the Fed talk about the labor market on Thursday, and for good reason, because when we look at the consumer price index shown in blue on a year-over-year rate of change against the unemployment rate, what happens as the unemployment rate rises, which we now see in the manufacturing sector, we see further signs from TGI Friday. Demand is plummeting. Well, that means at some point, when consumers have less money to spend, which is validated by the real retail sales data, well, it means inflation is indeed coming down despite the fact that it is rising at the manufacturing level. That will not last. And next thing you know, it's not inflation that's your problem, it's the labor market. But it's all about, of course, what we're seeing in the bond market as the Fed's reverse repo use has now declined to the lowest in more than 3 years. So while everyone's going to be talking about the labor market, the reality is the money markets have already voted there's going to be a rate cut. They know it. Declining usage suggests that money market investors are amply supplied with alternatives and see other products as more attractive compared to reverse repo. And that's not the case at all, because the reality is money markets can buy outside of overnight money. That means they can go out and buy 4-week, 3-month, 6-month T-bills. And the reality is, if you believe the Fed's going to cut, then you want to lock in rates right now where you can. What we're seeing in the reverse repo is that money markets are betting big. The Fed's cutting rates not once just in November, but another time in December. That's why money's leaving the reverse repo pool, is because the Fed's going to cut. It's not just about the labor market, it's about the manufacturing sector. All evidence now pointing the U.S. economy is indeed in an early stage of a recession. And when we go, the rest of the world, as you're about to see, stands no chance of survival. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.